higher by 2.5% as well. In fact, let's go straight across to the management to decode the numbers. Joining us live now on ET Now is Mr. Sanjiv Chadha, the MD and CEO of the bank. Now, what we've of course seen is the NIIs go up. Mr. Chadha, good morning. The NIIs have increased, but your net interest income for this quarter has come in low. Well, what exactly is going on? Can you just take us through it?
So, as you very correctly said, the NII has moved up well, both on account of the increase in loans and also the better margins we had. As far as non-interest income is concerned, we need to look at it in different components. The core component, of course, is fee income, which has gone up by about 12.5%. So that's reasonably satisfactory. But the biggest component in this is the mark-to-market gains or losses you get, depending on where interest rates are moving. Earlier, this component used to be accounted for below the operating profit line. It used to be there in provisioning. Now, as per the current guidelines, this is above the line. And it is here that while the repo rate has gone up only now, the markets were anticipating a rate increase. And therefore, there has been a mark-to-market loss on account of that portfolio. But this is something which you might argue was expected to some extent. We were in a regime where rates had been brought down to extraordinarily low levels because of the impact of COVID, and a rate normalization cycle was anticipated. And we have been able to absorb the impact of that and report decent numbers, both in terms of operating profit growth, growth in net profits. Going ahead also, my sense is that some of these headwinds from a rising interest rate scenario as far as the treasury portfolio is concerned will persist. But for us, as of now, our AFS book has got a modified duration of less than 2. And within that, about 40% is floating rate bonds. So we believe we should be able to absorb the impact, and the kind of improvement that you have seen in the profitability of the bank in the year that we have just closed should get sustained and carried forward into next year.
So, Mr. Chadha, taking this forward, and this is of course the hot topic right now, just because the rates are going up. What exactly is the breakup for the bank when it comes to fixed as well as floating? Have you already started repricing, protecting depositors' liabilities?
So first, just to put in context the year that we have closed. So we had guided at the beginning of the year that we would hope to improve our net interest margin by 10 basis points because they were challenging circumstances because of surplus liquidity. Actually, we have been able to deliver 30 basis points. NIMs have moved from 2.7% to 3%. As far as Q3 is concerned, even at that point in time, we had flagged that in the net interest margin, there is a one-off impact of about 10 basis points because of recovery in a particular account, which went largely to the interest line. And but for this one-off, our NIMs actually are unchanged from Q3. Going forward, again, I believe that it is normal that when interest rates are rising, in the short to medium term, there's some upside because of the lag between the repricing of liabilities and assets coming first. So we should benefit from that. And even otherwise, if you see the composition of our loan growth, it was rather tepid on the corporate loan side because it was a challenge getting appropriate margins which would be justified on a risk basis. We believe that in the current year, we should see better corporate growth, and also it should be possible to have decent margins as also loan growth on the corporate side. So we still believe we should have further improvement in margins. Like last year, we are again looking to improve them by 10 basis points. If we are lucky, we'll do better.
All right, let's get a move on then and understand the breakup in terms of your fixed book versus floating.
So most of our assets are floating, right? It's only, again, some of them get repriced immediately when the repo rate changes. So our external benchmark portfolio is about 26%. A further 10% is benchmarked to treasuries and the like, which gets repriced immediately. Apart from that, 50% is MCLR linked. That, again, gets repriced normally with a little bit of a lag. So that might be something which will play out over the year. But the home loans, car loans, the ones which are linked to external benchmark, they get repriced immediately.
And what about your provisions? Because they have come in higher on a sequential basis as well as on a yearly basis. Where is it exactly that you're seeing the stress in loans?
So one is, of course, that for some a large NBFC and a large retail account which became NPAs during the year, we have provided 100%. Apart from that, we have made over and above normal provisioning requirements some extra provisions because we believe that we had the capacity to do that this year, which is the reason why, again, you find that the credit cost is a little higher. In fact, in my opening remarks, I had drawn the distinction between the credit cost, which we have actually as a number, and what it would have been if it had not been for these extra provisions that we have made. But if we were to look at the medium-term trend, I believe both the improvement in credit quality by way of lower slippages as well as lower credit cost is something that should continue into this year.
Asset quality of banks have been improving. Bank of Baroda, no exception. Is this the way things are going to pan out, particularly for you, sir?
So I think there's been a broad trend which has been in train for some time. The corporate credit cycle has been improving over the last few years. To some extent, that improvement was clouded by the impact of COVID. But nevertheless, despite COVID, we have seen corporate slippages fall and also gross NPAs and net NPAs come down in consequence. Going ahead also, I think there's still some play left as far as the improvement in corporate credit cycle is concerned. And I believe that is what should primarily be driving further improvement in credit quality, both by way of slippages as well as by way of lower credit costs.
So you already hinted at it, that the credit cycle is going up. We've of course been seeing that in the fine print too. What kind of a pickup are you anticipating based on what you've already seen, and how's the corporate book doing?
So I think let's talk of retail first. So we had a growth of 17% in organic retail last year. Now this included certain categories where we have done really well, like car loans for a number of years, which grew by 20% YOY. Also, with the digital initiative now pretty mature, the unsecured retail personal loans, again, they are growing very healthily. They grew by 100% last year. We believe that this is something that will continue. And in terms of comparison, retail credit growth is likely to be faster as compared to corporate. Now, when it comes to corporate, it is not something which is very difficult to grow this portfolio also. The challenge was that because of the overhang of liquidity, it was very difficult to get a pricing which was appropriate to the risk that you are underwriting. Therefore, we chose to be disciplined in terms of corporate. And I think that is the stance we will continue. Although I must say that with the reset of interest rates and also draining of liquidity, it should be possible to both grow corporate as well as keep your margins intact.
Right, Mr. Chadha, great to have you on the show and get in all that perspective on how your quarterly performance was.